This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long at GordonTLong.com. I have Ronnie Stoeferle joining us from Vienna here this morning. Ronnie's been on Macro Analytics previously, discussing financial repression. Ronnie's a noted Austrian economist and money manager with Incrementum, based in Liechtenstein. And we've had a previous show where we told him where Liechtenstein was, Ronnie. So I'll refer everybody to the archives. Welcome.
Hi, Gord. Good to be back on the show.
Ronnie, we're here this morning to specifically discuss the 2015 edition of your In Gold We Trust report. This year, I believe, is the 9th edition. It's a very well-known report, and certainly a must-read. And before we get into the report, and at least the highlights of it, could you just give our listeners a background of how you came to write the report, what prompted it?
Absolutely. I was a very young research analyst back in the days at Erste Group in Vienna. And I started investing in stocks when I was already 13 or 14 years old. So I made it through the dot-com bubble. I learned my lessons. But I always really enjoyed following the markets, investing, and the whole beauty of anticipating events. And therefore, I had a small junior mining company that did tremendously well. And I didn't know too much about gold back in the days. I just knew that this mining stock did very well. So I went to my boss in 2006 and said, I've got this mining stock and it's really doing well. I'd love to learn more about gold and precious metals in general. Could you give me some time and allow me to report to write about gold? And he said, yeah, go ahead. And this was the birth of the first In Gold We Trust report. And they became bigger and bigger, and hopefully better and better. I always try to analyze the holistic view. So this is not about the demand from China. My reports, they try to gauge the big picture. So I'm mostly writing about monetary history, about central bank policy, about our fiat money system. I'm also writing about long-term topics like demographics. I'm writing about, of course, the demand coming from emerging markets, the so-called love trade. I'm writing about mining stocks. I'm writing about the over-indebtedness, more or less all over the world. I'm writing about technical analysis. So I think it's a very, very broad view. And that's also the reason why the report is quite lengthy. So this edition is roughly 150 pages. So you probably need to take an evening or an afternoon off and walk through the report.
Or minimally,
but it's worth.
Or minimally go through the slide deck that comes with it.
Exactly.
Because nobody does better graphic slides to distill complex arguments into very simple, easy to understand graphics than you do. So go to the slide set at a minimum and go through them. There's a lot of knowledge there. Ronnie, we're going to jump in so that we do have enough time. You brought about 10 slides out of that huge set just to give us a sense of some of the key messages in this year's report and some of the changes from previous reports, because I'm sure a lot of our listeners look at it on an annual basis when it comes out. And I have the very first chart up here now that shows the annualized change in gold historically. Can we begin right there?
Yeah, absolutely. It basically shows that from my point of view, there's a big divergence between what the market is thinking or saying about gold and what gold is actually doing. We have to emphasize that gold was basically going sideways last year, but we saw a tremendous rally in the US dollar. So I think gold held up pretty well in dollar terms. On the other hand, in euro terms, in Japanese yen, in almost every other fiat currency, gold was up significantly last year. So I think it's really interesting that the market is really frustrated and almost a bit agnostic when it comes to gold, despite the fact that it's holding up pretty well, because we have seen a deflationary or a disinflationary tsunami last year. I mean, oil was down more than 50% in roughly 7 months. Most of the other commodities were down big time, and gold held up pretty well. And I think that's a very good sign. This divergence between what the market and the price action is actually doing and what market participants are saying, because the sentiment regarding gold is as bearish as it can get.
Yeah, you know, when you mentioned the U.S. dollar, considering the dramatic upward movement in the U.S. dollar, the fact gold priced in U.S. dollars has been relatively flat here has been amazing. But you know, if you were buying, and there are ETFs buying gold in yen and hedging the yen, shorting it, which an ETF does, you've done really well. So the point I'd make, it's not about gold, it's about how you internationalize it and what currency that you're in, and whether you're in a inflationary environment. And your inflation signal indicator just this last month has changed to the upside in terms of upside in inflation, has it not?
Exactly, yeah. Our inflation model, I think it's quite innovative, because that's one of the main points that we're always making. Gold is not a good inflation hedge. It depends on the tendency, the direction of inflation. So if we see rising inflation, gold and mining stocks, and especially silver, are tremendously good investments. But when we're seeing disinflation last few years, then gold is suffering. So in our inflation signal, for example, the gold-silver ratio is a very important factor. I'm writing a big chapter about the gold-silver ratio and its beauty in anticipating moves in the report. I think it's a very, very interesting and important chapter for every gold investor. And it basically says that when the gold-silver ratio is falling, so silver is outperforming gold, that's a very good confirmation for an uptrend in gold. So if you really want to make sure that gold is kind of on the safe side, you want to have a falling gold-silver ratio. Every time gold is rising, despite silver is underperforming gold, then you should be a bit cautious. What you mentioned before, our inflation signal, I think it gave us in real time for the fund that we're managing a great signal last year. In August, it said we're seeing disinflation. We sold all our inflation-sensitive assets, mining equities, oil equities, gold, silver, and so on. We were out of the market. And since then, the signal has been neutral. And mid-May, it told us that we're experiencing rising inflation. And I think based on our model, but also based on the sentiment, based on the commitment of traders report, based on the seasonality, I think the entry point for gold is excellent. And I see it as a very, very asymmetrical trade. I think the downside is very limited, but the upside is much bigger than the downside, and that's basically what you want to have as a prudent investor.
We have for our listeners the details on the inflation signal indicator, what's involved in it, and it's available on a subscription basis to subscribers. Ronnie, I have moving along. I have up this chart on the pricing of gold in terms of yen. I had mentioned that earlier, but I thought this was really telling because it's a really a long-term historical, and it goes back to really the whole history of fiat currencies here.
Yeah, I mean, you really want to if somebody's asking you how is gold doing, you have to ask in which currency. And for example, in yen terms, gold is very close to a new all-time high. So not gold is doing so well. It's mostly the Japanese yen that is suffering big time. And the reason for that is, you know, it's what we call the Keynesian endgame. We are currently writing a book about Japan, and I think that Japan is already a few years ahead of us. Their debt to GDP is 250% at the moment. Their system is extremely fragile because they're so dependent on extremely low interest rates. So I think, going long the gold versus yen is probably a trade that you can do and take sleeping pills and wake up in 10 years and you will do really, really well. So I think, but we've got also plenty of other charts in the report saying that on a long-term basis, gold is rising in every currency, in every fiat currency. Because on a relative basis, it's just very scarce. The amount of gold is rising by 1.6, 1.7% per year, so-called stock-to-flow ratio that we already discussed once. However, on the other hand, if you take a look at central bank balance sheets, not only on the monetary base, but also on the broader monetary aggregates, they're rising much faster. And the reason for that is our financial and monetary system. We need constant rise in credit growth. We're addicted to debt, basically. So on a relative basis, gold is just extremely scarce. And that's why the price is rising. From my point of view, it's not the price of gold rising. It's just the purchasing power of fiat currencies depreciating continuously.
You got a chart that's showing what's comparing to stock PEs and the Shiller PE ratio.
Yeah, well, I'm writing quite a lot about opportunity costs. The thing is, people ask me about the fair value of gold and say that there's no fair value. There's no fair value for anything. There's no fair value for a Picasso picture or a good bottle of red wine or a glass of water. It's highly subjective, and therefore I'm always a bit I'm cautious when it comes to price targets and valuing things. But what you can do is analyze the opportunity costs. What are the most important opportunity costs of holding gold? It's, for example, equities, but it's also real interest rates. Real interest rates were rising a bit recently, and that gave gold definitely a hard time. On the other hand, having a look at the stock markets rising since 2009, without any major correction, I would say that US stock market, for example, is not very, very cheap at the moment. Having a look at the Shiller PE, for example, it's on the third highest level in its history since 1881. So I don't think that's a very good buy on those price levels. It doesn't mean that it can't go higher anymore, but talking about risk-reward ratios again, I think this is not as good as gold's risk-reward. However, I think that equities are definitely a big opportunity cost and kind of competitors to gold at the moment, which also means that as soon as stocks might roll over, I think that's going to be the time when gold will start rising big time again.
What about gold as an event hedge?
It is an event hedge, and I always want to show investors that you don't have to be a a hardcore gold bug and a person really kind of wanting the financial system to collapse and wanting to see hyperinflation. It's not about that. I think gold, for every prudent investor, gold really makes sense for every portfolio because it's got great characteristics, and that's why I'm writing about those portfolio characteristics for quite a while in the report. So gold is almost not correlated to equities. It's got a negative correlation to the US dollar, obviously. It's got a slightly negative correlation to bonds. So it makes sense to hold gold in your portfolio as a hedge. And what I'm showing in the report as well is how is gold doing on the really worst days of the S&P 500 when stocks are really getting sold off. And the result is that gold, but also precious metals are up. So roughly between 2 and 2.5%. And this confirms that gold as a portfolio stabilizer makes sense for every portfolio. Now, the percentage of your gold holdings, I mean, it depends. There are many really interesting academic studies suggesting between 5 to 15%. I would say perhaps even a bit more. It just depends on your perception of I would say, the upcoming crisis. If it's going to be a really, really a negative scenario, then you perhaps want to hold a bit more gold. But the message is gold makes sense in every portfolio because it's got great portfolio characteristics.
Yeah, I've always saw it as something that in the 8 to 10% range, but I was talking to Nick Barishoff at BMG Bullion, and he's a global expert in this field. He believes it should be 20% now because he now sees it as a strategic investment by the nature of the situation we now have from a global monetary. So he says he believes it should be higher now, though he believes in that kind of ratio I was talking about. But he also emphatically says it needs to be diversified within that between gold, silver, platinum, and the precious metals in general, with various mix within it. And then an element of internationalization of where that's actually held or how you bought it. So it's not just a matter of gold, it's a matter of a number of parameters.
Absolutely.
Ronnie, you mentioned earlier the importance of the gold-silver ratio. Could you, we have a chart up here now on that. Could you help our listeners who may not be familiar the importance of that ratio and what it's telling us now?
Yeah, at the moment, it seems that it's kind of rolling over. I think it's a very, very interesting setup at the moment. We're expecting that silver will really continue outperforming gold going forward because there are many signs that inflation will become a topic again. We shouldn't forget that in third and in fourth quarter, we've got the base effect. So because of the slump in oil prices, especially in the fourth quarter, we will see rising inflation numbers again. So real interest rates will come down. And therefore, I think it's for inflation-sensitive assets, it's a very good environment. We should not forget that last year, there was a big deflation scare in the markets, even in Germany. And you know, the Germans are really averse when it comes to inflation. There was even, I'm quoting it in the report, there was a study. They've been asking the Germans, what's your biggest fear? And the second biggest fear was inflation.
After Greece or?
No.
Okay.
The first was, I think, getting sick or anything. The second was inflation. The third was, I think, losing a job. And probably the fourth or the fifth was not becoming a football world champion again. But I don't know. But what I want to say is the Germans are really serious when it comes to inflation. And even they were made to be scared of deflation last year. So this was kind of the reason why the ECB, that was created as a bit similar as the German Bundesbank, what they said basically, why they were allowed to introduce quantitative easing in the Eurozone as well. And I mean, 1.1 trillion euros, that's quite a lot of money. So I think this deflation scare was something really big. And when people say, there's no inflation at the moment, I say, no, it depends how you define inflation. We're seeing major inflation. We're seeing asset price inflation all over. We don't see any price inflation yet, but price inflation will come. And I'm quoting Murray Rothbard quite lengthy in the report, saying that first there's always asset price inflation, and then there's consumer price inflation, and this will happen. And the gold-silver ratio is very accurate when it comes to because it's very sensitive to changes in inflation. And what I'm showing on this chart is the S&P 500 versus the gold-silver ratio. Now, why is there such a big divergence since 2011? I think the reason is that back in the days, central bank policy was able to create price inflation much easier just by, lowering interest rates, and they thought, okay, the economy works like a thermostat, and you lower interest rates and then inflation will rise and the economy will pick up. But since 2011, this doesn't work anymore because the inflation is only showing up in asset prices at the moment. And this is what the chart is basically telling us. But this also means that there's some, how should I say, perhaps the divergence will be closed sooner or later, which would mean that asset price inflation will stop and consumer price inflation will become a bigger topic again.
You said how sensitive the German people are to inflation. And I have another very important signal indicator that you have, and that is at Oktoberfest, what a liter of beer has been moving at, and in terms of a per ounce of gold. What's this chart telling us?
That's probably the chart that is most often republished or quoted. People love that chart. It's showing.
We're so boring in Northern. We have the McDonald's hamburger index.
But you go to you got to go to the Oktoberfest in Munich. It's really quite a lot of fun. And actually, I wanted to show the idea was a few years ago to show that gold is kind of purchasing, storing or helping you conserving your purchasing power. And I downloaded quite a lot of price series, and then I found out that there's a very long time series for the price of a mass, which is one liter of beer at the Munich Oktoberfest, and it starts in 1950. So I said, okay, let's do a ratio between the price of 1 liter of beer at the Oktoberfest and gold. What's your purchasing power, your beer purchasing power? And interesting thing is that the annual beer inflation at the Oktoberfest is, I think, 4.5%. And I think that's really kind of the inflation that people are feeling. They know that those inflation numbers that are calculated are just statistics and that they don't have too much to do with real life. But at the Oktoberfest, the price of a liter of beer is rising by 5% every year. So measured in gold, your purchasing power is pretty stable. And in the mean, I think it's 87 liters of beer that you can buy with 1 ounce of gold. So next time you go to Munich, Gord, bring an ounce of gold and a few friends, and you're gonna have a good time.
An ounce, everybody will have a good time. I've had many fine evenings in the Hofbrauhaus, I can tell you. So, I want to get to how gold holds up in the inflationary environment, but you have 2 slides that you brought that really talks about gold and the real Fed funds rate and what's happening with the bonds. Can we talk about that briefly?
Yeah, sure. So When it comes to real interest rates, that's one of the most important opportunity costs. And what I'm showing on this chart is basically three phases. We have seen 1970s, end of Bretton Woods, although Richard Nixon said that he only temporarily closes the gold window. But we've seen a major downtrend in the dollar and a big uptrend in the price of gold, obviously. One of the main reasons was that we have seen mostly negative real interest rates in the 70s, and that's the best environment for gold. Then Paul Volcker, his kind of story was, or his target was to kill inflation. So he hiked interest rates very aggressively up to 20%. And yeah, I think he did a pretty good job. And the US economy, of course, suffered, but it was also some sort of a healing process. So within the next 2 decades, the Great Moderation, as it was called, we have seen mostly positive real interest rates, and gold really had a hard time during that 2 decades. And now, since 2000, we are experiencing mostly negative real interest rates again, which is a good environment for gold. Although, what I'm also showing on this chart is not the absolute level of the real interest rates are important, but rather the direction. And since 2011, because of this disinflation, we have experienced rising real interest rates, although they are still in negative territory. But still, it was a tough environment for gold. So going forward, I think a very, very important point that I'm making in the report is when you compare 1980 Paul Volcker, his task, his aim was to kill inflation, to get inflation numbers down. Now, 2015. What central bankers want to do is to create inflation, to fight this disinflationary pressure, and they will do everything that's possible and allowed to finally create inflation. So that's a completely different setup, and that's why I think that real interest rates will become much more negative again, because we just can't afford positive real interest rates because of our debt levels. And what on the next chart is a bit more of a short.
Ronnie, to interrupt, 2 of the 4 cornerstones of financial repression, which is a macroprudential policy, which the central banks are following, is to have negative real interest rates and inflation targeting. And that's precisely what you just said is happening. And I can concur that that's exactly what the policies are. So how successful they're going to be is not the issue. The issue is the direction. It's going to be, these attempts are going to be sustained. Yeah. And if they're going to be sustained success, there's the fallout. And this is a completely different environment than Paul Volcker put in place.
Absolutely.
I happen to live through seeing a mortgage go to 20%. I remember those days very well.
Yeah, I mean, the system
he was my hero.
The system nowadays is so much more dependent, and I would say addicted to low rates and negative real interest rates, that I think it's tough to really compare it to those times. And the thing is, I think back in the days, we had huge pile of debt for the government, but private over indebtedness wasn't the big problem, and we didn't have the financial sector wasn't that big and important for the economy. So I think the problem is much bigger and much more opaque also than back in the days.
Yeah, there's so many more complications today, and one of them right off the top is a 1% move in interest rates on a 30-year bond is a devaluation of the bond by about 20%. And why that's important is the financial markets around the world are underpinned by collateral, which are bonds. We have a $555 trillion swaps market, interest in currencies, that's fundamentally collateralized on bonds. 1%, 20%. You ever had a margin call, Ronnie? I mean, that is called a monumental proportion. So you just can't allow interest rates right now. Never mind the government having to pay a higher rate. They're going to do everything in their power to at least attempt to stop that rate increasing. Whether they'll be successful, that's a whole other discussion.
Yeah, I mean, what I'm writing in the report is, you know, the fact that the big word in the markets in the last year was tapering. Everybody was talking about tapering. And I mean, the fact that QE had to be, you know, stopped very carefully, that already shows you that this economy is highly dependent on monetary stimulus, because QE1 and QE2 were just stopped. Now everybody is talking about the rate hike. The big discussion is it's gonna come in September or October or December. For me, it's a bit like waiting for Godot. Godot just didn't come, but everybody was waiting for it. Perhaps there's gonna be 25 basis points, just to show some strength by Yellen. But compared to Volcker, that's a different game. So I think everybody's saying that, you know, now gold will be having a tough time because interest rates will be rising. I'm not so sure about it. And what I'm also writing about in the report is I've just been crunching the numbers. How did gold do during rate hike cycles? And everybody would say, okay, rising rates means falling gold. That's not true. As we have seen from 2004 to 2007, we have seen from 1977 till 1980, interest rates were rising and gold was also rising. So it really depends on real inflation, on real rates, how they are developing. And from my point, it's fairly easy. Deflation cannot be allowed. So governments will do, or central banks will do everything in their mandate to create inflation. Perhaps GDP targeting will happen in the US sooner or later, but deflation has to be avoided, whatever it takes. We will see negative real interest rates. We will probably see much more financial repression going forward. And in such an environment, it just makes sense to hold gold. What I'm writing in the summary of the report is, just have to check it in English because I know it in German. I'm saying, you know, you remember the Titanic? Even the allegedly unsinkable Titanic had lifeboats. So, I mean, everybody thought the Titanic cannot sink, yeah, but it still had lifeboats. So even if you think this will all end well, get a lifeboat in form of gold. It just makes sense. And if you don't believe in gold, and you know the whole discussion is always very emotional. There are people loving gold and people hating gold. There's nothing in between. But I think it's just in this environment with huge monetary experiments going on, and we're all parts of those experiments, it just makes sense to hold some gold.
Just like it makes sense to always have lifeboats on a ship,
exactly.
Even though and I buy insurance for my house, and I don't ever want to collect it.
Yeah.
But I still buy it, and so right now we have very choppy seas out there, and I have people running around my house with torches. So, and I don't think the central banks have that good a hold on these issues, you know. And right now, whether we have inflation or deflation, how successful they are, precious metals can win in both environments. And the last slide I've got up is this gold in deflation. Yeah. And I thought this is really telling. Can we just wrap with that slide?
Sure. I've been crunching the numbers again, having a look at long-term studies. And it's showing that gold, but also to a certain extent silver, is doing well in deflationary environments as well. I mean, since 1971, we have to say that there was only one very short episode of deflation. And that also shows you that this is a new monetary chapter since 1971, because back in the days, and I've got a very long-term chart in my last report showing from 1861 until 1944. You often had deflation, you had inflation. It was basically 50-50, but since 1971, we only had in 2008, for a very short time, we had deflation. However, gold does well in deflation because it's regarded as money, and what you want to have in deflation is cash. You want to be overweight cash. In deflation, everybody is talking about counterparty risk and so on. So gold does well in deflation. Gold does well in terms in an environment of rising inflation. Gold is suffering in disinflation. And we have experienced disinflation since 2011 and especially last year. And this is the reason why the central banks are really getting nervous at the moment. And I think there's some sort of a floor that the central banks will take in, because they say, okay, we will do whatever it takes to avoid further disinflation. And I think one main point that I'm always making is based on my view on the Austrian School of Economics. Central banks or economists, they are not able to grasp the economy and our whole system in their very sophisticated econometric models. It just doesn't work. So it doesn't make sense to control the quantity of bananas or of whatever. It doesn't make sense to control the quantity of money, and I think there's nobody around that really knows how much money or how much banana the economy needs. We know, and market participants would set the prices for bananas, but also for money. And I think the distortions that central banks are creating at the moment, the fact that saving money doesn't make sense on with negative interest rates, that there are so many bubbles that are blown up. This is something that should make you rethink this narrative of the track record of central bankers, because just have a look at the most recent history. They've been blowing up bubbles all over. First of all, it was the dot-com bubble when that Greenspan basically blew up. Then we've had the housing bubble, and now it's the bubble is basically in the center of our financial system, because bonds are, the epicenter of this system. And yeah, I fear that this won't end too well. So, as I've said, in such an environment, it makes sense to hold gold.
We seem to have arrived at the sweet spot, Ronnie. If the central banks are successful and they get inflation, good for gold.
Yeah.
If they're unsuccessful and fail, we get de-inflation, good for gold. What's not good is that they continue to be able to successfully kick the can down the road and have disinflation. And the chances are, I think we've ran out of runway because of the malinvestment, mispricing of risk, lack of price discovery. There's just so many things that are kind of coming to fruition. And so we can debate either way, but that's why precious metals right now look like a very good insurance policy at this particular point in time. That's kind of what I'm concluding. Ronnie, any last comments you'd like to make, and how can they find out where to get the report?
Well, it's of course on our webpage. I think it's also on your webpage. It will be hopefully all over the web. Last year we've had roughly 1 million downloads, confirmed downloads for the report. It's 150 pages. We've got it in German and in English, not in Chinese yet, but perhaps next year.
Likely.
And and I think there are some really new aspects of gold, some also very philosophical aspects. For example, I'm quoting a study about Ruland, who was an advisor to Otto von Bismarck in Germany, and he analyzed why big cultures were going down and what the reasons for that was. So I'm also writing about those topics that are perhaps not really to be expected in a classical research paper by an investment house. So I hope all of your listeners enjoy reading it, and I'm glad that it's finally out because it's been quite a lot of work.
That and the book you wrote too, right?
Yeah.
Because we're going to have Ronnie back a little later in the summer to talk about his English version of his German book on another subject. So, which a lot of this research also folds into. Ronnie, we have to break. Always enjoy our conversations.
Thank you very much.
And let's hope we have a great year in 2015.
Absolutely. Thank you very much.
Bye.
Take care. Bye-bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.